Welcome back to the channel where technical analysis is simplified. My name is Michael. I hope you're doing well. And in this video here, I'm going to be zooming right out and talk about what I believe is coming up by the way of crypto's fifth and final wave up before a big picture bear market. Sure, there've been bear markets in the past and we're currently in one right now, but what we haven't seen, at least in my opinion, is a secular bear market after one complete cycle up. Now, the analysis I use to help me with this big picture analysis is called Elliott Wave. So I'm also going to be talking about that. Now, Elliott Wave has lots of rules, guidelines, and nuances. And while it might seem complicated, I'm going to strip it right back and break it down for you. In my opinion, it's a great form of technical analysis to get a big picture overview on the market. So by the end of this video, you're going to be having a map too of what could be coming up in this space. As usual, we have a lot of ground to cover, so let's just dive straight into it. This video is for education and entertainment purposes only because I'm not a financial advisor. Always do your own due diligence and your own research before making any financial decision. Make sure you check those links out in the description below. You can sign up for our free newsletter where we cover cryptocurrency, but also real estate and the economic cycle. Also, you can get yourself some free money and giveaways using those special links in the description below for those exchanges you can see listed there. And also, I do reference a TIA Gann swing indicator throughout all of my videos. It's my most used trading tool. I use it for basically every single one of my trading decisions. So you can also find that link in the description below. Elliott Wave is a form of technical analysis developed by the man himself, R.N. Elliott. Now, what he identified was key fractals and patterns that did repeat in the market based off human behavior. This style of analysis has been working for over a century and has been applied to all market types, be it the stock market, currencies, and now even cryptocurrency, and sometimes with pretty amazing accuracy. It works on short-term charts and also long-term charts where it breaks the wave structure down into impulsive and also corrective waves. Now, there are strict rules to give us an accurate Elliott wave count, and not only that, there's also guidelines to let us know if the wave count is actually forming a correct structure. There are waves within waves and cycles within cycles, but what's more important in my opinion is the psychology and what's actually going on at the time in the market at different parts of those waves. Now, to keep it simple and give you the rapid fire version, essentially there are 5 waves up and 3 waves down. And like I said before, these happen on the small time frame charts and also the big time frame charts. And we must see those patterns within patterns to get an accurate structure. Now, to display this on Bitcoin, you can see going back to the start of time, we had 1, 2, 3, 4, 5 waves up and then 1, 2, 3 waves down. Now, this pattern repeats over and over. And like I said, small scale and also big scale. And just to go through a few more, 1, 2, 3, 4, 5, 1, 2, 3. So if you can count to 5, you can do pretty well with this type of analysis. Now, also, like I said before, there are a few rules that must be adhered to get an accurate structure. Now, if counting to 5 is all you need to do to get the wave structure, you're going to like even more that there's only 3 fundamental rules to make up an accurate Elliott wave count. And those 3 rules, quite simply, are wave 2 cannot go below the low of wave 1. As you can see in this case here, it did not go lower than wave 1. Wave 3 cannot be the shortest wave out of a 5-wave structure. As you can see here, wave 3 is not the shortest out of this 5-wave structure. Now, it applies to every single time frame. Now, the third and final rule to get an accurate wave count is that wave 4 cannot go into the vicinity of wave 1 and 2. So wave 4 must always be a higher low beyond the top of wave 1. Now, while I'm looking at a bull market example, the same applies to bear markets too. It is just in complete reverse. But now with the 3 core rules, the fundamental rules that make out an accurate wave structure, there are dozens of guidelines and other helpful pointers to let us know if we are in an accurate wave count, but that's not the point of this video. What I really want to be paying attention to, which I think will help you even more, is the psychology and the human behavior going on at each part of the cycle. If you start paying attention to these things, you'll start to see how humans do act in the same way at the same times, and often there's similar headlines coming out in the news, which does affect everyone to act in the same way. There'll be loads of fear around when the market's around lows and lots of greed around when the markets are around tops. And when you do dive into technical analysis, you really start to see that the news is not there to help anybody with their finances. There's always some narrative that is the apparent underlying driver behind what the markets are doing. Sometimes it's the US dollar that's apparently driving the market, or oil prices, or inflation, or imports, exports, unrest, whatever it is, there's always a narrative going on, which is usually late to the party, and the news headlines are the worst after the market's already come down a long way, and it's exactly the wrong time to be getting fearful about the market. So that covers a little bit about what's happening around market bottoms, and I'm going to have more on that soon. But around market tops, there's always some other narrative talking about why this time it's different. There's options now, there's futures, there's ETFs, there's artificial intelligence, there's high frequency trading, there's metaverse, NFTs, whatever it is, there's always something which is telling us why why the market can only continue up. But to break it down a little bit more, let's look at some real market examples using Bitcoin as the case study. Now, to go through some examples, I'm going to be explaining the psychology of what's going on at each part of the cycle. We'll start out with wave one, and more importantly, the bottom of wave one, which is always the best time to be buying. Now, of course, we have a few examples to be looking at, so we have a lot of data to go back and review. And maybe we're even at the bottom of a wave one right now, but if not, I don't believe we're too far off. Now, at the start of wave ones, if you can try and picture what's going on, it's come off the back of a bear market, and almost always there's some story going out behind why the market can't recover. There's just no way out for whatever the asset is. Back in 2011, that was the first real bear market that cryptocurrency or Bitcoin had seen. There was talks about hacks, Bitcoin being unstable, malware risks, and even talks of it being untrustworthy and you need a reputation to build a currency, and Bitcoin's reputation was dead. Then at the bottom in 2015, there were more hacks, miners unable to repay their debt, attacks undermining the system, and wishful thinking that Bitcoin and crypto would ever recover. These quotes are coming from articles that were posted at the time, and you can just do a quick Google search to see what was going on. Then in 2018, the bubble had burst, institutions were not interested, ETFs weren't getting pushed to the market, more hacks, stablecoins depegged, you name it, there was something going on. And a great quote that I read from this time was that cryptocurrency was a hot potato that nobody wanted to touch. Now here we are in 2022 with bridge hacks, DeFi failures, stablecoin issues, sanctions, Mt. Gox payouts, and even talks of government bans crushing cryptocurrency. So they're just a few examples of what goes on around the lows of wave ones. And this isn't just true of cryptocurrency. You can go back to stock markets and just Google some headlines at those dates of those lows. And typically there'll be some pretty serious headlines coming out within a week or so of the actual low. And the market does reverse from those points. Now with wave one out of the way, we can look at wave twos. Now this is the first correction after the first move out. Now typically what's going on around wave twos, all of the bears come back out of the woodwork saying, I told you so, I knew this recovery was not going to be lived. And the news and hysteria can often be worse than at the lows of wave one. Wave twos are a really interesting time because like I just said before, the news can be worse and the sentiment can be much worse, but we don't see as big an effect in the price chart. The price just doesn't drop as low. Now after wave two comes wave three. There's no prizes for guessing that. And wave three is a really interesting one. And something also worth pointing out is that the masses are always 2 steps behind the market. Now wave three is typically the longest and the strongest wave in terms of time and price. Not always, but often. But in wave three, the bears eventually flip to bulls. It's the flippening, I like to call it, where that sentiment does change, where the bears have finally figured out it's in a bull market. It's in wave three that those big short positions eventually get closed. People are getting longer and longer towards the top, and you can just start to see a bit of an acceleration towards the top of that wave three, usually when the masses are getting too heavily invested at exactly the wrong time. Near the top of wave three, the average investor is getting fully invested and usually even taking out debts to get even more heavy in the market. And it's usually by that time the market starts to reverse and puts in a wave four. Wave fours are obviously needed in the market. They need a correction to put in a bit of a healthy move, but those that got too heavily invested at the tops of wave threes will always show a loss as well, even after the market had been up for so long. So once again, wave four is just a healthy correction in a bigger 5-wave structure, and that's when most people get a little bit disappointed if they got too heavily invested. But if they hold on long enough, if they hold on for wave five, their bullish bias gets reconfirmed. Now before we get to wave fives, it's in wave threes that the problems are starting to form in the market, but since everyone's become so bullish, they just get ignored or overlooked. So while the problems have been brewing, everyone's been getting bullish, and if they've sat through the correction of wave four, when wave five comes around, their bullish bias gets confirmed even more as the market does continue up and they get even more heavily invested. Now all the problems of wave three haven't disappeared, but all those bulls that did turn bullish a little bit too late, they're heavily in the market and believe it's never going to end. They think the bull market is just going to continue indefinitely. So after the 5th wave comes one of the biggest legs down or legs up if you're talking a bear market after the 5-wave structure did start. Now those who turned bullish too late in the 3rd wave and it went all in even a second time around at the end of the 5th, just keep buying up on that leg down thinking it's just a normal correction and we're going to be continuing up from that point. In this cycle here, it's been the famous buy the dip influencers and all of those that were following along with them. Now after every valid 5-wave structure comes a big picture correction, and no amount of hope is going to get your position back into a profit after the completion of that cycle. Now these bear market cycles tend to play out in 3 waves, or an ABC correction as it's called in Elliott Wave terms. And being savvy to where we believe we are within this ABC correction can give some valuable insights into where we believe the market's going for that next 5 waves up. But now to take a step back and look at the entire wave structure for Bitcoin for its entire history, we can see that we do have the potential for a macro 1, 2, 3, 4, and a 5th and final wave up. Now this is looking at the extreme big picture, and it's going to be after this 5th and final wave of the macro overall cycle that we do see a true secular bear market that could last many years. Now, it's for this reason here, I don't believe we're going to be in a sustained bear market from where we are at the moment. We've been down for about 220 days, and hey, maybe there's a few more months to go, but I do believe from that point forward, we're on for this fifth and final wave. So this is yet another piece of the puzzle I'm stalking for my cryptocurrency trading and investing, and being aware of where we could be on this next 5-wave structure, at least for me, is going to be providing some valuable insights. But that's a wrap on my macro overview with this style of analysis. There's a lot more detail and information we could be going into, but I hope this video here is giving you an overview of what to be expecting and looking out for, broadly speaking. If you did enjoy this video, do drop me a comment and also prompt me throughout my regular videos to do updates on this, because it is important to be keeping the big picture in mind. But that's all I've got for you today, and maybe we can do some more regular updates going into the details and weeds of the actual structure itself. And also keep in mind that there are never any guarantees in the market. These things are just guidelines and overviews that I use to help me with my analysis, trading, and also investing. Managing risk is always number one, and nothing ever replaces that. These maps are good overviews, at least for me, which really do help, so I hope they can give you some insights as well. That's it from me today. If you enjoyed this video, you know what to do, and until next time, I'll catch you then.